CBN Monetary Policy Committee meeting, usually held in Abuja, had recently decided to keep the monetary policy rate, MPR, at 27.5%. They also left the cash reserve ratio, CRR, at 50% for commercial banks and 16% for merchant banks, and the liquidity ratio at 30%. All 12 members of the committee agreed on this decision. The main reason for this move is to control inflation, which has slightly reduced to 23.71% in April 2025 from 24.23% in March. The CBN wants to ensure inflation continues to drop while keeping the economy stable. Hello Nigerians. Today we break down the recent Monetary Policy Committee MPC meeting usually held from time to time by the Central Bank of Nigeria. What the monetary policy rate MPR means and how these decisions affect you, whether you run a business or work in the informal sector or are simply trying to make ends meet. The monetary policy rate MPR is the interest rate the CBN lends to commercial banks. When the MPR is high, banks also raise their interest rates for loans to businesses and individuals. This makes borrowing more expensive. With the MPR at 27.5%, banks will charge higher interest rates on loans. This means it's more expensive for businesses, especially small and medium-sized enterprise, SMEs, to borrow money to grow, pay workers, or buy equipment, because banks must keep more money with the CBN, which is ICRR. They have less money to lend out. This makes it even harder for businesses to get loans, especially those in the informal sector, which makes up over half of Nigeria's economy. With higher borrowing costs and less access to loans, many businesses may delay expansion, cut jobs, or even close down. This can lead to fewer job opportunities and slower economic growth. For the commoners, if you want to take a loan for your business, buy a car, or pay school fees, you will face higher interest rates. This means you pay back more money over time. As loans become more expensive, people have less money to spend on goods and services. This can lead to lower sales for businesses, which can affect jobs and wages. The CBN goal is to reduce inflation so that the prices of food and other goods do not keep rising too quickly. If successful, this will help everyone in the long run, but in the short term, it can make life tougher for those who need loans. Considering the impact of the MPR across sectors, the informal sector, which includes market traders, artisans, and small business owners, will feel the impact the most. Many rely on microloans, which will now come with higher interest rates, making it harder to stay afloat. Then the real sector with industries like manufacturing and agriculture will also struggle with higher costs and reduced access to credit, affecting production and employment. While the CBN's decision aims to stabilize the economy and reduce inflation, it brings challenges for businesses and individuals in the short term. The government's role is crucial in providing support and creating a better environment for growth. Stay informed and plan wisely as we watch the impact of the MPR unfold. Do not forget to follow us on all social media platforms on Fact News Africa and Fact News Hausa.